ค่ะได้ละโอเคก็ได้เวลาการนำเสนอข้อมูลของบริษัท Peaches Shipping Public Company Limited นะคะก็คือ PSL ในข้อมูลของไตรมาส 1โดยคุณคาริท ฮาชิมกรรมการผู้จัดการก็จะนำเสนอข้อมูลในเรื่องของภาพรวมของอุตสาหกรรมแล้วก็คุณคุชูวาเดียกรรมการทางการเงินก็จะนำเสนอข้อมูลในเรื่องของตัวเลขทางการเงินแล้วก็ผลการดำเนินงานของไตรมาส 1ปีนี้แล้วก็ในช่วงสุดท้ายเป็นคำถามคำตอบซึ่งยินดีรับทั้งภาษาไทยภาษาอังกฤษนะคะเริ่มแรกคุณคาริทเชิญเลยค่ะ
I'll do that. As usual, we will break up the presentation into two parts, and we will discuss the industry structure in the first half, and then we will discuss the finances of the company in the second half. So as you can see from the first slide, pressure shipping is part of the dry cargo tramp freight market, and in that sector, we are represented in the handy size, in the Supramax, and in the Ultramax space. These are all geared ships. The slide that I have up for you is the Baltic Dry Index and shows you how it has been moving since 1985. If you look at the same market in terms of annual averages, it sort of gives you a little bit better picture, and you can see the cyclical nature of the business. In 1986, we had the previous all-time low of the BDI, which was at 715 points. Last year, unfortunately, took that title away and became the lowest ever at 7% below the last all-time low. So you can imagine in something like 30 years' time, there has been a significant amount of inflation in terms of cost. But in terms of earnings, we were at a level which was approximately 7-8% below the last all-time low. So last year was a very difficult year. Looking at the BDI, starting out in January of last year and coming up to the end of Q1, you can see that the BDI began the year at 473 points, went down to an all-time low of 290 points, whereafter making a recovery almost in a straight line all the way to 1,257 points in November last year. Thereafter, the market cooled down a little bit, ending the year at 961 points, from where the market has taken off and again has reached more than 1,338 points in the last days of March. Since then, the BDI has been coming down, and the latest BDI is slightly below 1,000 points. So if you look at averages, then you can see that the average in Q1 last year was 360 points. And as a result of this very low earnings via the low BDI, the scrapping in Q1 was very, very high and almost 14 million tons. And you can see as the BDI average has started to increase, which is the red line, you can see that the scrapping, which are the green bars, has started to fall and has almost become a very low number. So if you look at the average for the year, the average for the year was 673 points, and for the year last year, almost 30 million tons of ships were scrapped. Now compare that with Q1 of this year, when the BDI has been at an average of 945 points, very, very similar to the BDI of the last quarter of Q4. But look at the scrapping. In Q1 last year, we had almost 14 million tons scrapped. And in Q1 this year, we've had less than 5 million tons being scrapped. 2016 was a very unusual year. It was unusual because the expectations between what was to come on the demand side and what actually happened was very, very different. So for example, if you look at steel exports, the expectation at the beginning of last year was that steel exports would be flat or down by 2 to 3%. Actual exports at 108.46 million tons was exactly 3% below the year before number. The forecast for coal was to drop from 204 million deadweight tons in 2015 to about 180 million tons in 2016. Instead, Chinese coal for 2016 ended the year at 255 million tons. So roughly a swing of 75 million tons between an expectation of 180 and an actual of 255. If you look at iron ore imports, this was even more significant. Iron ore imports were expected to be flat at best or down by 2 or 3% or max 2 or 3% up. Instead of that, iron ore came in at 7.5% above the previous year. And to make you understand what this number is, it is like saying that China imported 32 metric tons of iron ore every single second of every single minute of every single hour and every single day of last year. So it was a very significant increase. Now, what were the reasons behind coal going up in such a big way in China? The reasons are basically linked with two things. One is pollution, and the other one is that many mines, smaller mines in China, are very unsafe, unregulated, and illegal, and where a lot of people die. So in the smaller mines, whenever they produce coal, they more or less every single day somebody is dying in these mines. So when people die, the relatives of the dead person come out to protest, as well as the surviving miners. They all come out and protest, and the Chinese government doesn't like that. So China has ordered the closure of up to 800 million metric tons of mining capacity starting out last year and by the end of 2019. So by 2020, they want to remove this 800 million metric tons of mining capacity. Last year, almost 290 million tons of mining capacity was shut down. In April last year, the Chinese government restricted the number of days that mines could work from 330 days to 276 days. Because of the closure of these mines, of this 290 million tons of mining capacity, and the restriction of the number of days that mines could work, output in China reduced, and therefore China had to import more coal. As a result, you can see clearly that the imports in China started to strengthen after the end of the first quarter of last year. The only issue now is that China has not gone back to the 276 days. They have now, in November, they went and changed the number of days allowed for mines to work back to the 330-day limit. They were supposed to change it back in March, again down to 276, but they have not done that. So as a result, coal mining in the first 3 months of this year has been up by 33%. Similarly, you will see that iron ore imports into China in the first 3 months of this year has also been up by about 12.5%. The big question is, can this all be sustainable by China? So if you look at the things that are going on, the changes that are taking place in the industry in China, for steel making, the Chinese government has promised that by the end of June this year, they will stop producing normal steel and they will only produce high quality, high grade steel. For producing high quality, high grade steel, you need very good ore and very good quality coke. Both of these are only available through imports. So imports should continue at a higher level so long as China stops the production of normal steel. Secondly, in terms of the pollution control, by stopping the smaller mines, China has also stopped producing very poor quality coal. If you burn poor quality coal, whether you burn it in a steel mill or in a power generating company, you will create a lot of pollution. And by stopping the production of this low grade coal, they're trying to reduce pollution. So we think that because of this, they will continue to import more coal. China has also stopped importing any coal from North Korea. Normally in a year, they get about 23 million tons of coal from North Korea. North Korea exports coal to China sometimes by land and a little bit by sea. But the ton-mile impact is very little because the sailing distance between North Korean ports and China is very short. Once this 23 million tons stops coming in from North Korea, China will have to substitute that either from Australia or from South Africa or from Colombia. In all such cases, the ton-mile will go up quite significantly. Coming to the data points in China, if we look at iron ore imports in Q1, as I said, it's up by almost 12.25% to 271.1 million metric tons. Coal imports in Q1 is up by 33.4%, up to 64.7 million metric tons. Steel production in the first quarter is up by 4.5% to up to 200 million tons. Steel inventories have gone up to 14.1 million metric tons. Steel exports have come down by 21 million tons. Therefore, China has consumed more steel in Q1 this year, almost by 10% as compared to last year. So that means China is using a lot of its own steel, not for exports anymore, but for their own infrastructure development. And a lot of this is going into the One Belt, One Road. If you look at the bar chart, it shows you the difference between the imports on a monthly basis for iron ore on the left-hand side and for coal on the right-hand side. The blue bars are for the months in the year 2016, and the orange bars or slightly brownish bars are for the months in 2017. And you can see clearly how strongly both iron ore and coal imports have grown in China. Similarly, if you look at grain, it has the same type of picture. You can see that even as far as grain is concerned, China is importing more grain this year than last year. If you look at steel inventory, if you look at steel production, steel inventory and steel exports, you can see that China is actually consuming more steel, because though inventories are slightly up, exports are significantly down and production is up. So that means the balance of the steel that is there between production, increase in inventory and reduction in exports is all going into infrastructure development within China. Coming to the supply side of the equation. If you look at the changes in the first quarter of this year, almost 12.3 million deadweight tons of ships have been added. Please keep in mind that last year, in the whole of last year, net addition was only 18.5 million deadweight tons. So in the first quarter of this year, you've had almost 2/3 of the entire net addition that has taken place last year. So supply has grown in Q1 much more strongly than all of last year's averages. And yet the market has reached a peak by the end of March. So it tells us that the demand side has also been growing quite strongly. This is the balance of ships still to come for the next 4 years, 17, 18, 19 and 20. And we have split them up into the different categories of sizes of ships as well as the different years. These are the orders placed in each specific year. So you can see that when markets were very high in 2007 and 8, ship owners went a little crazy and ordered too many ships. And now that the markets have come down, the ordering has become much more rational. This is a skyscraper chart to show you the amount of scrapping that has taken place in ships. And if in dry bulk ships. So if you see 1986, you can see that though the skyscraper is not as high as what you've seen in the last few years, it was still a much higher proportion of the existing fleet at that time. So it was almost 5% of the existing fleet. Currently, our scrapping, even at the peak level, which was in 2012, at 36 million tons, was just about 3% of the existing fleet at the time. So we need to still scrap some more ships to get the balance back. If you look at the difference between what is expected for delivery each year and what was physically delivered, you will see that the slippage has been averaging between 2010 and 2014 has been averaging around 35%. But in the years 15, 16, 17, this average has gone up to closer to 50%. Again, to show you the difference between January, February and March, the 3 months we've shown you both for 16 and 17, both in terms of deliveries as well as in terms of scrapping, and you can see the difference. You can see that though deliveries were less than last year in terms of actual deliveries, but scrapping was much higher last year in the first quarter than it was this year. And therefore, the net addition has been much higher in the first quarter than last year. So if we were to look at a 50% slippage factor, last year was 48%, and if we apply scrapping for 2017 at 29 million tons, at 22 million tons, and for 2018 at 37.5 million tons, then you will see that you will have a slight positive growth in deadweight tons during 2017, but a really nice significant negative growth during 2018. And the reason why we expect that there will be more scrapping is linked to certain regulatory requirements in shipping. But in the meantime, just looking on the demand side as to what Trump is going to do for us, though his campaign was very anti-global, pro-protectionism type of campaign rhetoric, his actual cabinet consists of multi-billionaires, one of whom is a very large ship owner. So we don't think that he's going to do anything to jeopardize shipping. Trump also wants to spend $1 trillion on the infrastructure in America, which means that America needs to import much more steel, much more cement, and much more wood because they don't have enough of that being produced in America. The fact that Trump also wants to build a wall or a fence linking or demarcating the border between Mexico and America has resulted in Mexico wanting to stop importing any corn from America. And corn from America is right now going at about 34 million tons per annum into Mexico. Now, the ton mile for that is very short. It's less than a 3-4 days sailing time from America to Mexico. But now Mexico has already started buying cargoes from Brazil. And Brazil is maybe something like a 25-day sail between a southern Brazilian port and from where the grain exports are there to Mexico. The other thing that Trump is doing, which would be interesting for shipping, is that he plans to create a budget deficit in America. If you create a budget deficit, which means the government needs to borrow more money, it means that interest rates will rise. We've already seen that the Federal Reserve has started to raise interest rates and most likely will raise it again in June. Now, raising interest rates does two important things for us. The first thing is that zombie companies that were kept alive because interest rates were so low will finally perish. And at the same time, you will see that two categories of people. One is the pensioners and the other is the savers who've had no return at all on their capital for the last 10 years will suddenly find that they're getting a reasonable return on their investments and therefore they will, on their savings, and therefore they will start to spend once again, which will be very good for the economy and therefore good for shipping. So the two regulatory items that are coming up, one is the ballast water management system. This requires that every ship, when it comes up for its next special survey, and a ship has to do a special survey every 5 years, on its 5th year, on its 5th birthday, it has to do it, on its 10th birthday, it has to do it, 15th birthday, 20th birthday. So anytime a 5-year cycle comes up for a ship, after the 8th of September of this year, they have to fit a ballast water treatment system into the ship, into the existing ship. Now, the ballast water treatment system will cost you between $500,000 and $1 million, including fitting charges, and the special survey cost for an older ship, like which is 15 years or older, will cost you at least $1 million. So between these two charges, the cost to the ship owner will be very high compared to the asset value. Asset values of ships which are 15 years or older are roughly at the $1.5 million mark, which is their scrap value. So we think that of this 115 million tons of ships, which are now over 15 years of age, we feel that a lot of them will come up for their next special survey in the next 1 or 2 years' time, and they will be forced to take a difficult decision whether to do the special survey, spend the money on the special survey and the ballast water management treatment, or simply scrap the ship. And right now, the way the market is going, we expect a lot of these ships to be scrapped. If those ships which were meant to be scrapped by the ballast water management system, by some magic, they remain alive, and that somebody pays for the cost and they don't have to experience it, then on the 1st of January 2020, you have the next regulatory requirement coming into force, which is the Clean Air Act, which will force ships to burn oil that has less than 0.5% sulfur content. Now, the older the ship, the older the engine, the less probability that it can burn clean oil. It cannot really burn clean oil because it was designed to burn very dirty oil. So ships which were designed to burn very dirty oil will have to be forced to either burn clean oil, which they cannot do, or to install a scrubber system whereby the gas that is coming out of the exhaust gas that is coming out of the engine will be cleaned and will show as if to say the ship was burning only 0.5% sulfur oil. But the cost of this scrubber system is very, very expensive. We have a quotation from a Western European supplier at $6.54 million per ship. Now, we managed to negotiate them down and remove some of the costs, and it's still a $4.5 million type of expense. And then you have the cost of fitting it on your ship. But the problem for scrubbers is not just that. First of all, there is an issue that the scrubbers have only been lab tested, they have not been tested in real life. So whether they will work in real life or not, we don't know. Secondly, we don't know whether the lab tests are absolutely authentic or there's been some cheating there. So again, it's something that we have to find out. And of course, the most important thing is that the cost of scrubbers is so expensive that most ship owners have confirmed that they will try to burn clean oil. But burning clean oil has a cost, because the cost of clean oil compared to the cost of the dirty oil that we burn today, the differential in cost, that is the difference in cost, is more than $400 per ton. So if you're burning 25 tons of oil, it means you're spending $10,000 extra per day that the ship is at sea. And most ships spend at least 200 days at sea. So that means you're talking about a $2 million type of expense. So from that point of view, a scrubber looks really cheap because you can get a payback within, say, 2 to 3 years' time. So it makes sense to buy a scrubber. But like I said, for a scrubber, we don't know whether they really work or not. So initially, maybe it's better to burn clean oil till such time as we can find a good scrubber system which really works in real life, and the price is economical, and the supplier is there to give us after-sales service. So that's what we plan to do at Pressure Shipping, so long as the price remains this high. But let's say that the price comes down tomorrow to an affordable level at $1 million or less, then that's something that we can seriously look at to install scrubbers, because the engines that we have and every ship in the world has are designed to burn dirty oil. They're not designed to burn clean oil. So when you burn clean oil in them, you are actually creating some problems for yourself. So you can do that for a short while and it'll be okay. But if you're doing it for a longer period of time, the engine will break down. and will have lots of spare part requirements. The other step that owners can take is to reduce the amount of oil that you burn if you're burning clean oil. So if you reduce, the only way to really reduce oil burning in a ship is to reduce the speed. So let's say that you're going at 12 knots per hour and you reduce the speed to 10 knots per hour, you will bring this 25 tons down to 17 tons and you'll save 8 tons of oil, which is a big savings. Now, when you do that, you're also effectively removing 17% of the supply side of ships. So whether it is by scrapping or by slow steaming, one way or the other, supply will be managed in the next 2 to 3 years' time, not because ship owners are responsible and they want to do the right thing, but because they're stupid and the regulators will force them to do it. And so that's how we will get balance finally in the business. So what did we as Pressure Shipping do looking at all this environment? The first thing we did is we said we need to raise money. So in 2015 in June, we had a rights issue and we got about $65 million into the company. Then during 2016, in the beginning part of the year, we raised $100 million of bonds. That bond was ranked as the best debt deal of the year. Then at the end of the year, we also raised another $55 million in the form of an unsecured bond. Then we sold 16 ships. Of those 16 ships, 15 ships went for recycling. If every ship owner in the world had done that, the market today would be higher than the market in 2008. But this is the problem with ship owners. They're not very responsible. So we did the right thing. Others are not doing the right thing. And therefore, we hope that the regulations will force them now to do the right thing. We've taken delivery of one Ultramax ship on the 18th of April. And we have sold one more older ship again in the month of April. So we have only one more ship to take delivery of in January of next year. So by the end of 2018, we will have 37 ships in our fleet. We have 36 right now. We'll have one more ship added in. And the average age at the end of the year will be about 7 years. So at the beginning of the year, it'll be around 6 years. Just some facts about China. I have already given you all the numbers, but annualizing them, if we were to look at GDP growth rates in the first quarter, it was 6.9%, much higher than what anybody had anticipated. If you look at in terms of iron ore imports, if we were to annualize that, we would come up to a number higher than last year. Last year was 1025. This year would be 1084 based on the first quarter. Coal imports last year was at 255. This year it will be at 259. So it's heading in a higher direction if we annualize the first quarter. If you look at steel production, last year was 807 million tons. If we look at the first quarter and annualize that, it works out to roughly the same number as last year. If you look at steel exports based on the first quarter, it will be down significantly compared to last year. And steel exports as a percentage of production would also drop to about the 10% level. Looking at some future numbers very quickly, iron ore trades, this is by a brokerage house called Howe Robinson's. So they feel that iron ore will go up to 1.5 billion tons for the year as compared to 1561 as compared to 1508 of last year. So there will be an increase of about 5%. If you look at coal trades, similarly they expect 1.4% increase to 1,210 million tons. If you look at grains, they expect a 5.4% increase to an annualized number of 566 million tons. And if you look at other minor bulk trades, they're looking at an increase of 1.4% to 1.6 billion tons. So overall, demand looks quite solid. And if you look at the global picture of all dry bulk cargoes, then it looks like that we will go for, we'll have a growth of 2.1% in terms of absolute numbers. And that should take us to 5.579 billion tons for the year. So our strategy at this stage is very, very simple. We have already sold all the older ships. We've expanded the fleet with the newer ships. And now we're waiting for the market to go up so that we can fix our ships on longer term contracts. So this is a snapshot view. It shows you what I've just told you about, that by the end of 2018, we'll have 37 ships. The average age would be down to 7.11 years at that time. The average size would be about 45,000 tons. In terms of the forward order book, you can see clearly that we have got a reasonable amount of ships covered on long-term contracts and at a reasonably high price. So once the market starts to improve, we will add to these numbers and try to make it grow strongly. In terms of market segmentation, you can see that the index ship for the Baltic Handysize was at $6,636 per day per ship. Against that, we had a $9,316 per day per ship. So we outperformed the index by 40%. On the Supermax sector, there were the index was at 781 points, or a time charter rate of 8,171. Our ships had a average of 6,701, or we underperformed by about 18%. Khushru will now take you through the financials of the company.
This is the current status of the new buildings. So now we have one ship left from Sanfu shipyard to be delivered. And as you know, as far as Sainty shipyard is concerned, there are 12 shipbuilding contracts for which we were not delivered any of those ships. And 9 out of these contracts are under litigation. These are the highlights of this quarter. If you compare it with the same quarter of last year, and if you compare it with the previous quarter, that is the last quarter of the previous year. If you compare it with the first quarter of last year, of course, the numbers look tremendously higher than what they were. But that is because of the fact that the first quarter of last year were based on the indexes and based on the freight rates at the lowest market point. So we have now, as you can see, a net profit is in the region of about $1 million negative. That is a loss of $1 million based on a time charter rate of about $8,500. So this shows you that we are now approaching break-even point. That if at all the time charter rate, once it goes up by about $400 or $500 per day per ship, we should be in profitable or positive profit level. So this is one key item to be noted. This is the one big takeaway. As far as the other numbers go, our operating expenses are down compared to both the quarters, the last quarter of previous year, the first quarter of previous year. And we expect that the operating expenses will remain for this year at around $4,200 to $4,300 or $4,350 level. So which will still be lower than what they were in the previous year. So that is essentially the big numbers or the big takeaways as far as this particular slide is concerned. Now, if you look at our financial position, once again, if you look at cash balances, cash equivalent, this is down compared to what it was at the end of last year by about $3 million. However, if you look at our long-term loans, they are down by about $6 million. So which indicates that this $3 million have gone towards the repayment of the long-term loans. However, the other $3 million came out of the operating cash flows, which once again shows that we are very, very close to cash break-even also. So therefore, once we have this additional $400, $500 per day per ship, we can get that, we will be now turning the corner in terms of profitability, and perhaps if the market sustains at this current level or becomes still better, then we should be in profitability region. Other than that, there is no major change. Our debentures remain the same. It's $155 million. You see a difference is only because of the accounting standard where we are forced to account the swap as well as the liability separately as liability and asset. So but otherwise the net position is that the debentures is the same. It's $155 million approximately. So shareholders' equity, again, because of the fact that our profit or loss was near about zero levels, $1 million loss, we are close to what it was at the end of last year. So this quarter has been a quarter of sort of consolidation or coming back up to closer and inching forward to a break-even point. We are still not there, but hopefully if the market sustains itself or gets slightly better, we would be now entering positive territory in terms of profitability, if the market sustains itself. This slide gives you the breakup of the operating expenses. As usual, first quarter is $4,200 per day per ship. The biggest component of these operating expenses, as you can see, is the crew costs, which is approximately 60%, slightly more than 60%. Manning and victualling expenses, you could consider them as crew costs. Other than that, once again, there is a major change in our dry docking special survey expenses, which is down by approximately 40%. So that is on account of the fact that now our fleet is younger, so therefore less dry docking expenses, and they are still many of the ships are newer, so therefore the dry docking and special survey costs are lower, and they have not yet reached the point at which we have to do. Many of our ships are brand new or a year old or 2 years old, so therefore these ships will reach their point end of this year or probably actually next year, and the older ships which required dry docking now have been sold. So this is a major change there. Other than that, there is no major change, but as we said, we expect that for the whole year, our operating expenses should remain at the low point, at the low level of around $4,300. This slide gives you the comparison. As usual, of course, once again, our operating expenses as compared to the industry benchmark, that is what the industry is doing, is around $1,000 to $1,400 less than the industry benchmark. So in that sense, once again, we are outperforming the industry in terms of operating expenses by a very wide margin. This is basically the same numbers, but in a chart form where the orange shows the industry number and the blue shows the company's numbers in terms of operating expenses. And as you can see, at all points, every year, every quarter, our operating expenses are around 20 to 25% less than what the industry is. This chart gives you average age of our fleet right from 1985 to 1995 to present, 1995 being the sort of first peak or peak level which we had reached, which was before this last boom or a peak market, which was in the region, which was in between 2003 and 2008. So that time the peak was about $6,600, $6,700 per day per ship. As against that, if you look at our previous peak was in the region of 16,500. So this gives you an indication, and that is reflected in the Baltic Dry Index chart also, which was shown to you earlier, that the Baltic Dry Index reached phenomenal heights during this particular period between 2003. It started off in 2003 end right till 2008, the middle of 2008. And of course, by the end of 2008, it had crashed down to a very low point. But in spite of the crash in 2008, if you look at our 2009, 2010, or even 2011 time charter earnings, they are still at very, very high and healthy levels. The reason being that at that time we had long-term charters in place at higher rates. And as and when these long-term charters started expiring, our time charter rates started coming down and then reflecting more of the spot market rates. So what you see in the last 3, 4, 5 years is the more or less the spot market rates, barring the 6 or 7 ships which we still have on long-term charters. Operating expenses, we were used to be in the $3,000 level. We breached 4,800, 5,000 levels for a 2-3 year period. But during that 2-3 year period, as you can see, our fleet was very, very old. We were over 20 years of age as a fleet. Once the fleet age started reducing, as we started recycling the older vessels or selling the older vessels and bringing in newer vessels, the operating expenses now have come down to a low point of $4,200. This one shows you the debt to equity ratio, or what was the level of debt. The peak was in 1997, 1998 during the time of the Asian financial crisis, where our debt to equity was at about 4 times. Since then, we have always come down. We've come down to 0 levels for 2 years when we prepaid all our debt and we were free of any debt or 0 debt. And thereafter, it has been creeping up gradually because of the new buildings or the new ships which have entered our fleet, and they have entered our fleet mostly through debt. However, we are still at a very healthy level of about 1.3 times the equity, which is a reasonably healthy level. A financial covenant requiring us to maintain this ratio at 1.8 for one bank, but otherwise generally two times. This is the ratio which compares debt with the cash flows. Obviously, this will look high during the past few years when the cash flows were on the lower side based on the market's rates, based on the market conditions. But as I said, if you look at the first quarter of this year, as we are approaching closer to break even, as we are approaching closer to positive profitability, this leverage ratio based on cash flow is also now becoming healthier. So from a peak of about 20 times, now we are at close to just about 13 times. And if this kind of a trend continues, we should touch the single digit mark and come very close to 6 or 7 times, which is what our financial covenant is. Right now, we are in breach of the financial covenants, but we get waivers from our banks for testing this particular ratio. And they are very happy or glad to give, because we are one of those few shipping companies in the last 2-3 years who haven't defaulted, who haven't asked for any rescheduling of principal repayments. In fact, we have actually prepaid or paid earlier or in advance in the last 2-3 years, sourced out of our bond proceeds, out of the debentures which we raised. So our banks are very happy to waive this particular covenant. This is a profitability chart. As you can see, we were at negative territory in cash terms or in book profit terms in 98-99. We also did that in 15-16 being worse than what it was in 98-99. And therefore, the amount of negative territory is more than what it was. And plus, of course, our balance sheet itself, the size of the balance sheet, the size of our assets, our value of our assets is much higher than what it was in 97-98. We are now once again very, very close. In terms of cash profitability, we are in very positive levels. As you can see, we are cash profitable now in this quarter after being cash negative in the last 2 years. We are now back to being cash positive and very, very close to being positive even in terms of the accounting profitability if you look at only the operations. This is the same number. Once again, similar numbers, negative in the last 2 years. Much of it is come out of the impairment or the loss on sale of our assets which we sold. The ships which we sold, as compared to their book values, they were sold at a lower value than what the book value was, and therefore they had to be either be impaired or a loss had to be booked as and when they were sold. If you took that out, the loss would still have been there, but it would have been approximately 50 to 60% of what the numbers you see there. Once again, Q1 2017, back to profitability, back to an approaching break even. Dividend, last 2 years, once again, couldn't have been. We were in a loss-making situation. We are now looking better. We have consistently paid out dividends, profitability permitting. Let us see how the year turns out. If the year turns out well enough, good enough, probably we are once again, we could be approaching, it may not be next quarter or next 2 quarters, but we could be approaching a point where once again we could restart our dividend payment policy. This is a brief financial profile. The big number being our assets. If you can see, they have grown from 780 to 900. Our equity has gone down because of the losses which we had incurred in spite of raising more equity. Our funded debt to equity, if you look at it 5 years or 6 years back, was around 0.6 times. We are now at 1.2, so not substantially higher in spite of these losses, in spite of the erosion in the equity which happened. Our fleet size, quite coincidentally, is exactly what it was in 2012. So we are now at 36 ships. The big difference here, of course, is that these ships now are much bigger. So our average size, as you saw the fleet chart, average size is much bigger than what it was in 2012. So in terms of capacity, in deadweight terms, our fleet is much larger than the number 36 indicates. We are back to decent profitability levels in terms of cash flow also. So our EBITDA for this quarter was about 11 million, which is approximately 60% of what it was for the entire previous year. So again, once again, it has been a reasonably good quarter, coupled with, so coming out of the better rates which we achieved as compared to the previous year and the lower operating expenses. As you can see, we continue to win awards. We have just been nominated as one of the finalists for the Deal of the Year award for our bond issue of last year by Sea Trade Maritime Awards. We also won the Public Debt Deal of the Year for 2016 from Marine Money, which is a New York-based magazine, as you all know. Great Circle Shipping Agency, GCSA, that's GCSA, is a management subsidiary of Pressure Shipping, wholly owned subsidiary, is also a finalist in the Sea Trade Maritime Awards for ship management. Pressure Shipping, the ship owning company, is a finalist as a ship owner or operator, once again in the Sea Trade Maritime Awards Asia. So we are there among the top points. Recently, or it's not so recent now, about 2 years back, we also were the recipients of the Sustainability Investment Awards from the SET. We have always been ranked very high in terms of corporate governance, both locally by the Thai stock market, by the Thai IOD, as well as other Asian organizations outside Thailand. So corporate governance is something which for us is important. We continue to focus on it as much as we can and as more than what ordinarily anybody else would be, because we try and not only focus on it or comply with corporate governance for the sake of complying with them, but we firmly believe that that is something which is very, very important for us. And therefore, consistently, we have been ranked as the 5-star rated or excellent rated in terms of corporate governance in the Thai stock market, which is an annual assessment done by the IOD in Thailand. This is once again snapshot of some of the awards. We have the international rankings coming in every year from Marine Money. The next ranking should come in a couple of months. Probably that should be higher than what we have been ranked in the previous 2-3 years. In spite of our low rankings, generally our industry peers or these particular magazine which comes out with the rankings always have a good word or two to say about the company, notwithstanding whatever the ranking would be. In terms of shareholder returns, if you had invested in 1993, which is the IPO, in the share of the company, today in spite of the lower share price, it would still have returned to you approximately 12 times your investment if you had invested at that time. If you had invested at different times, if you had invested in 93, as I said, it would be 12 times. But if you had invested in 95, it would have still been 3.3 times, and so on until. However, if you had invested in 2015, you would have been at about 0.75 times of what your investment would be. But if this can be held for a reasonably long-term period, as you can see, that can change very, very easily. And once again, come to a very healthy return point. With that, we end our presentation and are happy to answer any questions which you may have.
Yeah. So as I said, the scrubber cost was at $6.5 million, but after negotiations, they've come down to $4.5 million, and we expect that the fitment cost would be at least another $500,000. Yeah. But we would not put up scrubbers if that was the cost. If the cost comes to $1 million or lower for the scrubber, and maybe $500,000 for the fitment, then yes, we would certainly look at it.
Yes, several questions, if you don't mind, Khun Khalid.
Sure.
First of all, just to refresh my understanding, could you explain your segment that you are in, Handysize, Supermax, and Ultramax? What sort of products do these ship? As in which one are steel, coal, iron ore, etc., etc. And second question pertaining to these questions is, it seems that there will be quite a large new chips on Ultramax segment as compared to the other two. Is there any particular reason for that, and what is the sort of demand supply outlook for each segment, if you can? Thank you.
So in terms of the products that we carry, whether it's the Handysize, Supermax, Ultramax, Supermax and Ultramax also carry coal. Okay, they also carry coal. They also carry some iron ore, not too much, but a little bit. But all of them carry cargoes like grain, animal feed ingredients, sugar, rice, fertilizers and their raw materials like sulfur, rock phosphate, including finished fertilizers, forestry products like logs, timber, plywood, steel in all its form. So flat products, coils, bars, everything would be carried, angles. We would also be carrying scrap. Then comes the mineral cargoes. We'd carry all forms of mineral cargoes other than iron ore. As I said, iron ore is meant for the bigger ship, but we do carry it in the Ultramaxes and the Supermaxes. So other than that, like copper concentrate, zinc concentrate, silver concentrate, gold concentrate, we carry all of that because they move in smaller lots like chrome ore, ferrochrome. We also carry gypsum, soda ash, and a variety of other specialized minerals.
And this goes for handysize as well.
Yes, for all the ships.
All the ships that you do.
Handysize up to Ultramax.
Okay.
Except that Supermax and Ultramax will also carry coal and iron ore.
I see.
A lot of coal, but little bit of iron ore. So that takes care of all the types of cargoes that we carry. Now, you also wanted to know why we invested in the Ultramax.
Yeah, I mean, an industry capacity increase this year seems to be quite large.
Sure. So the reason why we went in for Ultramax is that the Ultramax ship has a better quality engine and a larger propeller, so which allows it to sail at a much lower cost of consumption of oil as compared to, say, the Supermax. So when you compare Supermax and Ultramax, they're very close to each other. Supermax is about 56,000, 57,000 size. Ultramax is about 64,000 size. So you get a 15% increase in cargo capacity, but actually you get a 25% reduction in the consumption of oil.
Right.
So that's the reason why we have invested more in these ships. When the markets are poor, like they were till, say, the end of last year, then all these rates get compressed and they're all very close to each other. There's hardly any differentiation. But like, say, for example, in the first quarter of this year, like we underperformed the Supermax index by about 20%. But if you looked at our Ultramaxes, they outperformed compared to the index, the Supermax index, because there's no index as yet for the Ultramax. They outperformed by more than 20%. So there was a gap now of 40% between the Supermax performance and the Ultramax performance. So that is the big difference, and this difference will keep widening as the market goes up.
I see. Okay. And the next question is, you were saying that you were approaching the break-even TC rate per ship per day, which I understand it to be about $9,000 US. Is that correct?
It's about, see, like right now, what we've shown you that for last quarter, we had $8,500 odd per day per ship. We need about $500 odd more. Closer to 9,000, 9,100 is where we will have full, no profit, no loss. That means we'll cover full interest, full depreciation, full admin charges.
And what is the equivalent BDI level, just to have a sort of a, an understanding at current point in time?
Okay, so if you look at the BDI, if you look at the quarter 4 BDI, it was higher than the quarter 1 BDI. Q4 last year was higher as an average than Q1 this year. But last year, even though the BDI was higher, our average earnings per day per ship were around $8,000 a day. Now they're 8,500, even though BDI is slightly less. So you can't compare directly 1 to 1 with the BDI. I just wanted to show this to you. But I would say that anywhere around 1,200, 1,250 points, we would be breaking even.
Yeah, because there's a time lag, correct?
Not necessarily a time lag. That's not because of the time lag, because the BDI consists of 4 sub-indices. Yeah. Yes, time lag, there is some impact of that, but it's mainly because there are 4 sub-indices. They have equal weightage. So one sub-index is Capesize, another is Panamax, third is Supermax, and the fourth is Handysize. Now the Handy and the Supermax don't fluctuate too much on a daily basis, while the Capes and the Panamaxes, they fluctuate a lot on a daily basis. And therefore the BDI moves much more in sync with Capes and Panamaxes rather than the smaller size. And that's the reason why, even though the BDI is, is changing in a different way, say for example, the average BDI between Q4 and Q1 this year, Q1 was slightly less, but our earnings were at least 5% more. So what I'm trying to get at is that it's not direct, you can't directly correlate it with the BDI, because it depends on which portion of the BDI has gone up more or come down more in that quarter.
Okay, just one more question on BDI. Is it quite fair to understand it this way, that the spike in BDI last year from the low was largely due to what happened in China, and it is likely still to be the case going forward, that China dictate the seaborne trade and hence the BDI index?
Yes, as I said,
to a large extent.
See, the demand side, China is a very important pillar, and China has significantly outperformed in the first quarter. Now, China's major imports are coal and iron ore, where both those cargoes, we don't really carry a lot of them.
Yeah.
So that's why I said the BDI goes up and down with what China does much more significantly than for our smaller size.
But that there is still a knock-on impact on the.
Yes,
the
there is a
side.
sentiment change. It's like saying in the stock exchange of Thailand, if the big caps start to move, everything moves with them. If they come down, then everything comes down with them.
But in reality, the TC rate for you would move along with the because you
should work that way, but not in the same proportion. What I'm trying to get at is that percentage-wise, if you just look at the BDI and apply it to us, you will get a wrong answer.
Yeah.
See, like had you applied that between Q4 and Q1, you would have thought we'd have earned less, but we in fact earned more.
Sure.
Okay, so you can't really just look at BDI and plot it and then look at us. Better would be to take an average of the Supermax and the Baltic Handy Size Index and look at those two indexes and then plot it against us. Yes, you'd get a much better picture.
Okay, last two quick questions. What is the internal outlook for BDI for this year for you? Just to get a sense.
We think that it's going to be better than last year. Question is how much better? We really don't know.
Right.
I mean, Q1 took us by surprise. We never thought it would be as high as it was.
Okay.
And again, now in the month of April, we didn't expect the market to come down so sharply, and it has. So the market still has the propensity to surprise all of us. Even though we are in the market every day, it still catches us off guard.
In terms of gearing and at that level, I suppose that you're already taking up a lot of your new chips already in terms of schedule. So going forward, given that you're sort of returning to cash profitabilities, I suppose, would you be planning to sort of pay down debt and do it like the last cycles?
Yes, yes. We would try to pay down debt. If the market, just to give you a simple example, let's say that our break even is 9,000. And let's say the market goes to average for our ships to 15,000. So $6,000 more. Now, $6,000 more per day means a net profitability of $2 million per ship per year. So if we have got 37 ships, it's a $74 million profitability. Now to this profitability, you have to add the cash part of it, which is the depreciation, which is another $2,200 odd per day per ship, which if you take it on a yearly basis would be closer to $800,000 again, $750,000. So you're talking about per ship almost $750,000 more of $1 million. So you're talking about another, say, $30 million of profit. So in that case, cash profit will be more than $100 million. So we need just 2 or 3 years of that to become debt free.
I'm sorry, just one quick last question. From your experience, 30 years running, the shipping business, how would you compare the current situation, the last 4 or 5, tough years, to the past? As in, are we still moving in cycles of where, when things really get tough, it slow bleeds to death for the other less profitable peers, or has fundamental changes that hence we, the downturn might be more prolonged than we have seen in the past? Well, I'm not sure that you understand the questions, but.
See, you must not forget that the cycles in the past were much more mellow. Say, for example, I just quickly take you to. So if you look at this slide, now look at this period, say 1985 to 1997. Okay, see, the low point would be 550 points. The high point would be 2,500 points. Now look at the cycle from 2003 onwards. The low point would be about 2,000 points. The high point was 12,000 points. So, of course, when the markets behave in an irrational manner like they did in the last few years, people also go crazy. That's why if you look at if you look at this particular slide, it shows you how stupid people were and how many ships were ordered during that period of time. And if you look at this slide, it shows you, see, the markets were very strong in 2006 and 7. Look at 7 and 8, the number of ships ordered. Remember when in 2007, the average number of ships in that year was 360 million deadweight tons. And you ordered 170 million tons. It's crazy. Of course, that will result in a longer down cycle because so much more supply has been added on. Till you don't scrap enough ships, nothing much will change. And then again, it's not that that was the only year where you ordered. Then you ordered 3 years in a row, 100+ million ships. So that is what has created the longer cycle. Whether the future will hold similar type of longer cycles or shorter cycles will depend on how strong the market becomes or how weak it gets. Now it's become very weak, so people are not able to order any more ships. Like currently, for the first time, we have an order book ratio to existing supply of under 10%. It's not been like this, I think, since 2004. So it's been a long time before this has come down. Now, if it remains at this type of level, it means that we should have a nice, good cycle coming up in front of us. And plus, don't forget the regulatory changes, the two changes, ballast water management and clean air. Both these will take away a significant amount of tonnage, either through scrapping or recycling or through slow steaming. So both these two factors will come in a big way.
Just let others.
Thank you. Okay, so if there are no further questions, there's nothing also on the net, so I think time is also up. So we must thank you for being such a patient audience. Thank you so much. Sawasdee krap.